Hello, everybody. Welcome back to the podcast. Welcome back to my YouTube channel. Today, we have a very special guest today. Robinson Smith is with us again. He's been on the podcast before, but he's back joining us again today. Welcome, Rob. Nice to have you back.
It's a pleasure, Randy. Thank you for having me here.
No, my pleasure. Robinson Smith is a financial advisor. He's an educator, he's a speaker, and he's a best-selling author of a book called Master Your Mortgage for Financial Freedom. But Rob was also born into a family that has a history of financial management. And his dad actually wrote a book some years ago called The Smith Manoeuvre, which is quite famous. And that book basically teaches people how to make the interest on their mortgage on their principal residence tax deductible here in Canada, which was a radical idea at the time. It's quite an elegant thing. And I'm going to ask you, Rob, to explain how some of that works. Rob came into the family business and he's since updated that book. He's updated it for 2023. Plus, like I say, he's written Master Your Mortgage for Financial Freedom, which was a bestseller on Amazon when it came out in 2019. I was just reading that it was a bestseller in 22 different categories on launch day. Man, congratulations. That's amazing.
Yeah. Thank you, Randy. It was a pretty successful launch. Absolutely.
Excellent. And today I know you're a sought after speaker. You're speaking at conferences, you're on podcasts, you're on television and radio. Thanks for coming back to my podcast. And so we're going to talk a little bit today about mortgages and taxes. I think most Canadians are aware that in the United States, Americans are able to deduct the interest on their mortgage loan for their principal residence. And we in Canada traditionally have not been able to do that. And that's where your father came up with the original Smith Maneuver. So, Robinson Smith, can you tell us a little bit about how that works, the Smith Maneuver?
Yeah. Yeah. As you mentioned, I was sort of born into a financial family here. My father, Fraser, was a financial consultant in Vancouver back in the day, and back in the mid 80s. And as I mentioned earlier when we spoke last time, Randy, he was interested in the fact that, as you mentioned, the Americans can deduct a good portion of their principal residence mortgage interest, and we Canadians could not.
Right.
So we developed this strategy, which effectively accomplishes what the Americans are able to do with their interest on their mortgage. Now, that being said, we already have an advantage over the Americans in the fact that we have a principal residence capital gains exemption when we sell our home. The Americans do not. But if you were to look at these two tax advantages, deductible mortgage interest or capital gains exemption, you might want to be able to deduct the interest on your mortgage rather than have that capital gains exemption. But with this strategy that my father developed, you get the best of both worlds. So while you're converting the mortgage interest on your mortgage to tax deductions, you're still getting that principal residence capital gains exemption when you sell. So best of both worlds. And now in this respect, we're even better off than our American cousins. Now, that doesn't mean we've got it easy. I'm sure we'll talk about that a bit later. Things are not easy at all here in Canada. But yeah, basically the strategy really gives you a financial advantage when you have the appropriate type of mortgage. It's critical you have the right one for your own given situation. We've got Smith Manoeuvre certified professional mortgage brokers who can help Canadians out in that respect. But if you do have that appropriate type of mortgage, then you're able to access the equity in your home as fast as you're creating it with that mortgage payment. As we know, let's say I've got a $3,000 mortgage payment, a good portion of that goes to non-deductible interest. That's the price we pay for borrowing the bank's money. And that money we pay in interest is gone. We don't see any benefit from it. But some of that payment does reduce principal. And with the right mortgage, whatever is reduced on principal, let's say it's $1,500, I can pull back that $1,500 in real time, and I can put it into income generating assets, investment assets. And because these investment assets have a reasonable expectation of generating income, I can deduct the interest on that. So all I'm doing is converting bad debt to good debt. And in the process, because it's tax deductible interest on that reborrowing to invest, I'm reducing my tax bill, which puts cash in my pockets, which allows me to prepay my mortgage each year when I get that refund. And then I can pull that out to invest as well. So I'm reducing my tax bill. I'm getting rid of my expensive non-deductible mortgage debt faster, and I'm building an investment portfolio which is going to be there for me in retirement. Whereas most Canadians not employing the Smith Manoeuvre, they don't have that ability because of limited resources. They focus on paying out the mortgage rather than getting invested. And so
So true.
they're in trouble in retirement, right? We hear about this all the time.
So true. And I know a little bit about the Smith maneuver. It's quite elegant, actually, the way it's set up. It's well, again, I better let you describe it. I have some familiarity with it, but it involves taking out a line of credit, and it's a special mortgage that you have to have in order to make this thing work. And can you tell us a little bit about what kind of mortgage? Because the banks have, everybody thinks a mortgage is a mortgage. It's a mortgage loan, but there are different
Yeah.
kinds of mortgage loans.
Yes, absolutely. When we Canadians think of a mortgage, we think of one big chunk of money that we borrow from the bank, and we use that to buy our house along with a down payment we scrape together.
Right.
And over the next 25, 30 years, we promise our spouse, our banker, and our God that we're going to make that mortgage payment 25, 30 years, and eventually we'll have paid off that mortgage. And the problem with that is that, if I have a $450,000 mortgage, I have to earn over $1 million before I'll eventually pay that back, because not only do I have to pay back that mortgage amount that I borrowed, but I also have to pay interest on it. And I can only do so after I pay tax.
Right.
So it's terribly expensive. Now, with the right type of mortgage, it's called a readvanceable mortgage. And all the banks have them. All the banks have a readvanceable mortgage. There are monoline lenders out there that have readvanceable mortgages, but they're not all created equal. And what readvanceable mortgage may be best for you, Randy, may not be best for me. Maybe a different one is best for me. And that's why we have these Smith Manoeuvre certified professional mortgage brokers. So they can look at everyone's personal situation. But once we have the appropriate mortgage, as I was mentioning earlier, there's two components to it. One is that amortizing, non-deductible, expensive mortgage debt that I use to buy my house. And attached to that is a home equity line of credit, like you were talking about earlier.
Right.
And that line of credit, the limit on that may start at $0, but when I make my first mortgage payment, whatever reduces principal is allowed to be reborrowed back from that line of credit. So my limit on that line of credit goes from $0 to $1,500 in the case that my mortgage payment reduces the principal by $1,500. I pull that out, I invest it. Now, what many Canadians do is they'll have this readvanceable mortgage already. Maybe their bank, mortgage specialist, their mortgage broker put them into one, but no one explained to them how to maximize the use of this type of tool. And it's a very, very valuable tool. And if they don't know how to use it, what do? They get a mortgage statement, at the end of each month, and they notice this line of credit is increasing. I've got access to this money each and every month. It's more and more and more. And so they think to themselves, well, I've got enough to make a car payment on a nice car. I've got enough. I can pull out. I can go on vacation.
Let's go to Hawaii. Yeah.
That's, and so all they're doing in this case, Randy, is they're paying down their expensive mortgage debt on one side, and they're borrowing back expensive non-deductible debt on the other side. And what are they doing with the assets, quote unquote, that they're purchasing each month? These assets are depreciating assets. That's car that they're paying for depreciates in value. Vacations disappear. Foods go. Right? Yeah. So just learning how to use this type of mortgage to your best tax advantage is what the Smith Manoeuvre is all about, to create wealth.
Okay, that makes perfect sense. And I know most Canadians, and I speak to them every day, you're absolutely right. That's how they think. If they've got a little bit extra credit on available to them, my goodness, especially post-pandemic, the first thing they're saying was, let's go on a trip or two. I know a bunch of people that have gone on 2 or even 3 trips post-pandemic. It's like, and big ones. Because they're not thinking like an investor, they're thinking like a consumer. Or let's go out, buy a new BMW. Why not? Right? Maybe not the smartest thing to do.
Yeah, this is what we call wealth destruction. What we want to accomplish is wealth creation, to use debt to our advantage. And this is what the wealthy understand very clearly. There's 2 types of debt. Don't acquire non-deductible debt. Acquire tax-deductible debt. Acquire assets which are going to appreciate in value and be there for you in retirement. For yourself, for your family, for your children, to avoid, living in your kid's basement or having to sign up for a reverse mortgage where you're selling your house back to your bank after you worked for the bank for 35 years. Right? Or having to work in your retirement.
So true. So this line of credit is connected. It's attached to the mortgage loan. They're connected. They're one and the same. And it's an automatic thing where if the amount of your your payment, you're paying down the principal, the amount that you pay down automatically increases the amount of funds available on your line of credit. The two are directly connected. And then the
That is
idea
that.
is you take that money then, and that's now in your line of credit, which is increasing every month, and you use that money to make investments. And in making an investment, your interest on that line of credit is tax deductible.
That is absolutely correct. And what we hear all the time, Randy, is there's so much misinformation about the strategy out there, which is why I created the Smith Manoeuvre Certified Professional Network,
Right.
specifically trained
I
financial
know a
professionals.
couple of them. There are people all across Canada. I know for sure.
No, that's right. We're up close to 90 now. But we hear a lot because of this misinformation out there. We hear, hey, I know what the Smith Maneuver is. I got a mortgage with Royal Bank. All I got to do is go get a HELOC with some other lender, and now I can pull this money out and I can invest it. That's not the Smith Maneuver.
Right.
And that is the wrong type of financing structure. So that's why it's critical you get the right one.
Right. Now, HELOCs, you mentioned that word, which is a home equity line of credit for our listeners. They have increased the mortgage rates on that, or the interest rates on HELOCs have increased quite a bit. Has that affected the Smith Maneuver in any way? Because you're paying quite a bit more now on a HELOC than you were even 2 years ago.
We've definitely seen a lot of rate increases over a short period of time.
Tell me about it.
And so this is part of the discussion I see out there is, well, Smith Maneuver is not going to work with high rates, only works with low rates. And again, this is tied into the misinformation out there. But we have to remember that this strategy was pioneered by my father back in the mid 80s. And what were the interest rates like then?
I remember it well. Yes, they were. That's
and
right.
If the Smith Maneuver didn't work when rates were double digits, we wouldn't be talking right now, Randy, quite frankly, right?
Yeah.
It wouldn't have been developed. But the nice thing about the Smith Maneuver is it's very robust. When interest rates are low, that means that each month I have relatively more to invest. So in the previous example, we were talking about $1,500 to invest each month when interest rates are low. So I'm investing a significant amount. Does great things for my future. Each and every month I'm putting this away. But my tax relief will relatively, compared to high rates, be a bit smaller than it would be. So I have a little bit less than otherwise to prepay my mortgage each year. However, that's nicely offset by the fact that I have a whole bunch of money to invest each month. Now, when rates increase, we see the opposite happen. Excuse me. Maybe we've got $1,200 to invest each month as opposed to $1,500, but because rates are high, my tax relief is higher, which means at tax time, when I get my refund, it's larger than it would be when rates were low. So now I have more to prepay my mortgage, more to reborrow and get invested each year with that tax refund. So it's like a teeter-totter. It's like a seesaw here. When rates go up, one benefit increases, the other goes down. When rates go the other way, so does the seesaw.
Right. So now, one of the things, and we talked about this one time before, is that I would think that a lot of people, it's a great, the first thing this is fantastic. You know, if I can get to claim the interest on my taxes, that's fantastic against my taxes. But one of the things is that after 20 years, if you're not doing the Smith Maneuver, or after 25 years, in theory, your house is paid off, right? You're debt free. Using the Smith Maneuver, after 25 years, you still have the same amount of debt, except that it's now investment debt, right? The loan is still there, and that investment debt is conceivably making you some money if you've made some good investments with it, plus it's tax deductible interest. So, but that's one of the things. How do you explain to people, say, well, wait a minute, after 25 years, I'm still going to owe the same amount of money? That's got to be an objection that comes up sometimes.
Well, that is an objection, not so much amongst the younger homeowners, because they've grown up with all this debt anyway, student loans. I mean, we're just a really indebted society. And so they've already resigned themselves to the fact that they're going to have debt to the day they die. And now we introduce the Smith Maneuver to them and say, well, if I'm already going to have debt to the day I die, I might as well make it tax deductible rather than have it non-deductible. It's a no-brainer. The older generations, they were grown up being told by someone older and wiser than them that the best thing to do is be completely clear title by the time you
pay it off. Right on. That's how I was brought up. Yep.
That's right. And so this is when you're talking about the strategy with someone older, Like, well, hold on. I thought you wanted to be clear title, mortgage free by the time you hit retirement. So there is that hurdle, that mental hurdle for them to get over. But we've got the Smith Man calculator. You plug the numbers in, and you can say, look, if you don't do the Smith maneuver, by the time you hit retirement, you're going to have a clear title house, yes,
Right.
but
Right.
you're going to have an investment portfolio of $0. Now, when you do the Smith maneuver, you are going to have debt against the house. It's going to be fully tax deductible, which has benefited you all these years that you've had it. But you're also going to have an investment portfolio of X amount of dollars. And so the question is, what is this strategy worth to a typical Canadian homeowner? And we're seeing net benefits of, over the course of a typical 25-year amortized mortgage, net improvement in your financial situation of $300,000, $400,000. That's just the most basic scenario of the strategy. And when we say net of $300,000 to $400,000, that's assuming that once 25 years into the future, you've got an investment portfolio. If you sold some of that investment portfolio to pay off all that tax deductible debt, if you chose to do that,
Right.
you would still be ahead by $300,000 to $400,000 versus if you paid off that mortgage conventionally. And then we throw in the accelerators that we have for the strategy, and we're regularly seeing net worth improvements of 7, 9, upwards of over $1 million net worth improvement over a typical 25-year amortized mortgage. And so the question for the people who are ingrained, they've suffered from this inertia of this thought process of needing to be clear title. When you show those values to them, do you want a net worth improvement of $900,000 or do you want a net worth improvement of $0? And that's when they start saying, okay, I'm going to look into this concept
makes sense
debt,
to me. How do you work it when, most people live about 7 or 8 years in one house and then they're going to move? It's typical. I think Stats Canada will say it's about 7 or 8 years. What happens when they're going to sell their house and buy a different one? Does the Smith maneuver get ported over? Can that be done, or how does that work?
There's a very specific process that gets followed. I mean, selling a home, moving house is
I got to move to Calgary. Got to move to Calgary. Got a new job.
That's right. The challenge there is when you're working with financial professionals who tell you they're implementing the Smith maneuver for you. When that time comes to move house, they're not going to know what to do. And so what's going to happen is you've been working hard for 7 years, generating these tax deductions, generating this investment portfolio. Now you have to move. The professional is not going to understand how they can successfully transfer that tax deductible debt from the house you're selling over to the house that you're buying. And therefore, you're going to have to start all over again. So that, again, is why it's so important to work with people who fully understand the strategy, who've taken the course that we provide and become Smith Manoeuvre certified professionals. Because the last thing you want to do is have to start over again. You want to maintain that tax deductible debt and that investment portfolio that you've worked hard to create.
Do your guys, does your network of people, do they help them with making those investments? Like, let's say somebody says, I want to do this. I definitely want to do this, but where am I going to invest those funds? I have no idea. Stock market, T-bills. What am I going to do with this money? How do they give them investment advice to do?
Well, it depends on which type of Smith Manoeuvre certified professional you are, right?
Right.
We're training up mortgage brokers, investment advisors.
Yeah, I know a couple of them here in Ontario who are now with you, big time.
And accountants and insurance brokers. So we're training up all the various types of financial professionals a Canadian should surround themselves with in any event, as far as I'm concerned, doing the strategy or not.
Agree.
But now when it comes time to implement the strategy, typically your first stop is an SMCP mortgage broker, right? They'll understand which mortgage you need in order to successfully implement the strategy, because without the right mortgage, you can't even start it. So that's typically the place to start. Now, once you have the right type of financing, that SMCP mortgage broker can refer you over to a Smith Manoeuvre certified professional investment advisor who can look at, which is what I was for a dozen years, right? No longer doing that, but this SMCP investment advisor can say, okay, let's look at your situation. Let's figure out what you're interested in investing in, what you have some knowledge in, and then between the two of you or the three of you, depending on spouse or not, then you make that decision of what you want to invest in. And it's a broad universe, right? Stocks, bonds, mutual funds, mix, REITs, ETFs, investment, real estate. You can invest in your business, somebody else's business. I was going to say,
so you could buy a pre-construction condo. You could buy an investment property using that money as well.
the challenge is there are some things that if you invest into it, you think you may be able to deduct the interest, but CRA won't let you, right? There's some rules. And again,
Okay.
this is why it's so important to have the SMCP. And so they go through that process, just like a regular investment advisor does
Sure.
with a client. But these people are Smith Manoeuvre certified professionals. They understand the strategy. They know the mortgage broker that referred the client to them. And then at tax time, the SMCP investment advisor can say, okay, you go see Bill. He's an SMCP accountant. And if that person wants to buy investment real estate because they freed up capital to do so, then one of the SMCPs they're already working with can say, hey, I know an SMCP realtor. We know each other. We work together. And they understand the strategy. And now you can get your first piece of investment property or your second. So all of these SMCPs work closely together, just like the model that we had built out here, my father and I, many years ago. Investment advisor, mortgage broker, accountant. Right? We all fully understood the strategy, could communicate. The client did not have to educate their accountant on what they were trying to do with the strategy.
Oh, yeah.
Mortgage, right? So,
So just to backstep one little bit for the benefit of our listeners, and I already know the answer to this, but CRA has completely approved the Smith Maneuver. They gave it its blessing. CRA, the Revenue Canada are completely happy with Smith Maneuver, right? It's a legal thing to do.
The challenge with the CRA is they're not going to come out and say, "Hey, everybody, this is okay." They're just not going to do that.
I understand you totally.
But the strategy has been around since the mid '80s. We're coming up to 40 years now.
Wow.
And in fact, when I was an investment advisor, I put a number of people into the strategy. Judges, lawyers, police officers, and I had some CRA employees as clients implementing the strategy. And
CRA employees. Okay.
Employees. You know, back in the 90s, when Fraser was really coming out with this, my dad, I might have said this last time, he got an unscheduled visit from two men in suits. And they said, we're from the CRA and we want to hear about the Smith Maneuver you're talking about.
Oh, no.
Right? And Dad went, oh, okay. Got his paper out, his pen. He went through the strategy, how it worked and all that stuff. And halfway through, one of the gentlemen leaned forward and said, would this work for a $70,000 mortgage? And Dad never heard from them again. That was 30 years ago.
No, but that's important to know because in Canada, we're so over-regulated that it's good to know that it's got the blessing of the CRA. That's good.
Yeah. I mean, the strategy relies on the fundamental principle in Canada that if I borrow to invest with a reasonable expectation of generating income, I can deduct the interest. Is the CRA going to change that? They can do anything they want, but I highly doubt it. Why?
Right.
Because the wealthy have been deducting interest they used to invest for years. Corporations deduct interest. Now the strategy opens it up for the same privilege of deducting interest to your common Canadian homeowner.
It's good to know. So if someone's interested in this, and I'm sure there will be a few, how do they get in touch with one of the people that are in your network? If they want to talk to a mortgage broker or an accountant that's part of your network, how do they reach them? I'm going to put some links underneath the video and on the podcast, both to Amazon so they can buy your book, and also if they want to reach out to somebody and maybe talk to an accountant or talk to a mortgage broker about how to set this up. How do they do that?
Well, as you mentioned, the book is available on Amazon, but it's also available from the website. And the nice thing about that is we've got some combo deals because we've got a homeowner's course, we've got the Smithman calculator, etc. But the website is smithman.net, SMITHMAN.
We'll do that too. We'll do that one too.
And on the website, there's on the top right, there's a link, find an SMCP. And find a Smith Manoeuvre certified professional. And they could submit the request to us, and then we'll connect them with an SMCP nearest them.
And you're across Canada. So if somebody in Nova Scotia wants this, you've got people across Canada, or how does that work? Okay, yep. Perfect.
Yeah, we can service people in any province.
Perfect. So the way I see it is that the biggest requirement is on the homeowner is a sense of discipline. They have to have discipline. So that, and they can track their progress as they're paying down their mortgage loan. They are increasing their line of credit, and they have to use that line of credit responsibly. They have to use that for investments, well thought out investments. Like we're not talking about gambling on, I don't know, Bitcoin or something, but it's something that makes sense, right? That's because this is your future you're talking about. Yeah. As long as they have that discipline, it should work, correct?
Yeah, the that's what we've seen many times over the years is people will start the Smith maneuver, and there's not a lot to it as regards to what a Canadian homeowner has to do on a regular basis to maintain it and progress.
Right.
But people fall off. They don't have the discipline. And the nice thing also, so hopefully they do, and they say, look, every month I'm going to get on my computer, just like I pay my credit card bill, I'm going to do the transaction I need to for my Smith maneuver. But the nice thing about having an SMCP you're working with is they can, help make sure you stay on track. Check in, right?
That's awesome. That really is awesome. I know a lot of people across Canada are doing this now. Absolutely. It's grown up a lot. And a lot of people have talked about, I'm talking to people all the time in the industry, and they all know about the Smith maneuver big time. So I believe, to change gears a little bit here, I believe we should talk a little bit about the state of the market today, because it's such a change in the last year and a half. Our Canadian government, God bless them, has decided to increase interest rates because they were surprised to find there was inflation. It must have come as a great shock. And this is after years of almost 0% mortgages for years and years, where people were getting mortgages for 1.5%, 2%, which is maybe not a Canadian, I don't want to point fingers, but because it was across the globe, really. And then all of a sudden, you had this tremendous bubble in real estate. Then the powers that be say, "Oh, we got inflation. My God, it costs a lot of money at the grocery store to fill your car up with gas." And since that decision, which I believe was in March of 2022 last year, it's only about 16 months ago, we've had 10 interest rate increases in Canada. 10. And what I saw was that earlier this year, like January, February of 2023, the Bank of Canada came out and they said, "Don't worry, folks. We believe this is it. We're not going to be increasing rates anymore. This is probably the end of it." And what happened in the real estate market is that it took off. People said, "Great, rates are not going to go up anymore. Let's go out and start looking again." And the market in Vancouver and Victoria and in the Toronto area and all across Canada took off. Prices started going up again. Then they surprised us, and they did a rate increase in June, even though they said they wouldn't. And then they did a second increase in July, each time a quarter point. So now we are looking at pretty high interest rates compared to what they were certainly 16 months ago. And how do you see, again, we're changing gears here, and this is just you and me talking about where do you see that we're headed with this market? Because you said about there's so much leverage, there's so much debt in the world, especially in Vancouver and especially in Toronto, in the real estate markets. They're just really high, like breathtakingly high prices. And there seems to be a shortage. I mean, there's all these different competing things. There's a shortage of housing for sure. We've got this surging immigration, and I'm a pro-immigration guy. We're all immigrants here. All of us, whether it's ourselves or our parents or grandparents, whatever, we're all immigrants. It's a big country. There's lots of room. But there doesn't seem to have been any management of the process. They threw the doors wide open and let in close to 1 million people last year. 1 million people in 1 year. But with no management. And so they'd never stop to think that, well, wait a minute, we need to make sure that there's enough places for these people to live, whether it's to rent or to own. And nobody did that. And then plus you've got different levels of bureaucracy. You've got the federal government with immigration. You got the provincial governments with their, basically legislating where you can build, where you can't build. And then you got municipal governments that are all tied up with NIMBYs and work permits that can take up to 5 years to get a building permit to build a high rise. 5 years of red tape. Where do you see that we're headed right now? I've interviewed tons of people in the industry, some pretty high ranking guys in politics, and nobody seems to really have an idea of where we're headed. Like what's going to happen next? You've got to buy a house in Vancouver. I don't know about Victoria, but I'm sure you're pretty close. It's like $1.5 million for just a modest little house. Same thing here. If I'm in Mississauga, but in the city of Toronto or Mississauga or anywhere around the GTA, you can't really get a detached house for under $1 million, and condos are pushing 600 up to 700,000 for a condo. I mean, it's expensive. And now you're looking at 5.5% interest rates, and the stress test is still in effect. So if it's 5.5% interest, you got to qualify at 7.5%. And that's creating a lot of problems for first-time buyers, especially. And my biggest concern is the renewals on mortgages, because there's so many people out there that that bought a house or bought a condo and their mortgage rate is 2%, and they've got it for 5 years, and they're saying, well, we got 3 years to go. People say, well, how come there's no listings? It's because if they list their house that was mortgaged at 2% and they're going to buy something else, if they're not porting that mortgage, or even if they are, it's going to blend up and they're going to go from 2% to 5.5% or thereabouts. That's why nobody's moving. So what do you think? Other than that, everything's perfect, Rob. Everything's perfect. So I'm not sure. This is just something, this is a little bit off topic, but you're a player in this industry. And what are your thoughts on where we're headed?
Well, there's certainly a ton of uncertainty out there. I mean,
yes,
you said it yourself. You talk to a lot of people, and there's a lot of people who don't know where things are going. And the challenge with that is we don't have anyone in the various levels of government who are putting together a viable plan. Like you said, we've had all this immigration and nowhere to house them. And
no thought put into it.
No thought. And so I don't know where things are going. I think very few people actually do.
I love an honest answer. I don't think the Bank of Canada knows where this is headed. I don't think they have a clue.
Well, and the interesting thing here is we've got the Bank of Canada who, in order to stabilize the lives of Canadians with regards to inflation, they've got to destroy the lives of Canadians by increasing these rates. And they may not think of it that way, but
interesting way to put it.
The only way that they can control inflation is to increase rates. What happens when we increase rates? People lose their homes, people lose their jobs, people lose their businesses, people lose their relationships because of money stresses, divorces.
Right.
I mean, it's in order to save Canadians, they have to destroy Canadians. I find that fascinating.
Wow.
And we've got competing goals. We got the Bank of Canada, which wants to increase rates. We got various government departments. They want to stimulate the economy, and so it's not a comfortable place to be right now. And my final word on this, considering I've got no prognostications about where it's all heading, Randy, is that we have to take care of ourselves, because no one else is going to take care of ourselves. Of us for us.
Yes.
So we have to do what we can to improve our financial situation. When we look at inflation, yes, it's coming down, but it's still relatively high. We have to fight inflation. And if we are of the mindset, like we talked earlier, Randy, about I have to be mortgage free by the time I hit retirement, that means I have to pay down my mortgage as fast as possible, which means I have to increase my equity as fast as possible. I'm increasing the amount of value in my home, which is earning less than 0%. And so what does that mean? Well, now I've got $200,000, $400,000, $800,000 of equity in my home. Fantastic. Well, $800,000 earning you less than 0% over the course of 20, 25 years, that doesn't make financial sense. We got to put that equity to work wisely in order to combat inflation, in order to be able to take care of ourselves and our loved ones in retirement. Otherwise, we're looking at some pretty nasty, I just read not too long ago, I forgot the stat exactly, but something around 30%, that might be completely wrong, but it was an astounding percentage of people approaching retirement age had less than $5,000 put away. That's not going to cut it.
No, it's not, for sure.
Something to protect ourselves. Absolutely.
Yeah.
Whether it's a Smith maneuver or not, we have to take responsibility. We have to act.
I think you're right on. As Canadians, we get a bit complacent, I think, because it's a pretty good country overall. Mm-hmm. And we expect that people are going to take care of us. The government's going to take care of us. Well, that may not necessarily be true. And I think you're right. You need to be a bit proactive. If someone came to you, what's your best demographic? What's the best age of person to begin this? Is it someone just starting out with their first condo and they're 26 years old, or is it if someone is middle aged, let's say they're 50 and up, maybe a little over 50, can they still do this effectively?
Yeah. Ideally, the younger you are, the better you are, because the more time you have to take advantage of compound growth with that investment portfolio.
Right.
The challenge there is you require at least 20% equity in the home in order to get the right type of mortgage we were talking about. And a lot of first-time home buyers, when they're young, they'll put a lot less than 20% down. So they'll have to wait a bit, or maybe there's a way to get to 20%. Now, when we start to hit 45, 50, 55 years old, we do see people who have the requisite equity in the home, at least 20%. They've got decent jobs, decent income, and there's still a relatively long period of time that they plan on being alive. And
Yes.
people are living longer these days.
Yes.
So if I'm 50 years old and I start the Smith Maneuver and I've got a 25-year mortgage, well, chances are pretty good I can get that down to 15, 17, 15, maybe less than 10 years.
Right.
By the time I convert that. And then I've got a lot of years after that I have to support myself in retirement. And ideally, I've got an investment portfolio which I can start drawing income from, right, through the Smith Maneuver. So, there have been people who have been in their 70s who have started the strategy.
Really?
Because
okay.
As far as I'm concerned, the Smith Maneuver being a debt conversion strategy, if you have bad debt, you have to look at converting it to good debt. You've got the debt already. Right? You've got the debt already. Would you like to make it work for you or work against you?
Rob, this makes perfect sense, my friend. It does. And I'm glad we had a chance to talk again this time. I think everybody should take a look at this because you're absolutely right. If you're, and I was brought up old school, buy a house and pay it off. That was the advice I got from my dad. And that's okay, but it's kind of only half the equation. You're missing out on the possibilities of using that debt to build a portfolio at the very same time. So I think everybody should take a look at the Smith Maneuver, and everybody should talk to one of your guys in your network, over 90 people strong across Canada. And again, I'm going to put all that contact information underneath the podcast and underneath the YouTube video today. And I urge everybody to give Robinson Smith a call and his network a call. And especially in these uncertain times when there's a lot of uncertainty in the world, a lot of people are not quite sure where we're going to be headed. I think just taking that proactive response and doing something a little bit extra to protect yourself, I think is an excellent idea. So thank you, sir. Thank you, Robinson. That's Rob, it's great to talk to you again. All the best to you, sir, out in beautiful, sunny Victoria, BC. And I wish you the best. Have a wonderful summer. And you're welcome to come back on the podcast anytime you like.
Anytime you want, Randy.
Okay, a pleasure. Take care, and thanks again for being on board today.
Thank you, Randy.